As that great Chicagoan Ferris Bueller once noted, life moves pretty fast. For the time being, we are well positioned to wait for greater clarity before considering any adjustments to our policy stance.
Hello and welcome to The Week Ahead on Nomura Podcasts. I'm your host, Andrew Ticehurst from our Global Markets Research team, and today is Thursday, the 17th of April. We are recording this podcast a little earlier than normal this week on Thursday, and that's due to the approaching holiday and long weekend in many centres. We certainly hope you get to spend some downtime with family and friends over this period. Now, onto markets. We've seen some calm return this week. This has coincided with President Trump making some tariff concessions for tech companies and for auto parts, suggesting that a Trump put is in play, and with the president also signalling big progress in talks with Japanese officials. But I think we have to say this is an uneasy calm. New sectoral tariffs are still likely coming, while tensions with China remain elevated, and with the president's apparent efforts to encourage other countries to help hem in China, those tensions appear unlikely to fade quickly. And while overall effective tariff rates have come down from peak levels, they are still very elevated historically. And with that, we think there will be a material hit to global growth. This week, we've also seen the Bank of Canada and Bank of Korea announce decisions to leave their policy rates unchanged, while the European Central Bank delivered a 25 basis point rate cut, as was widely expected. In this episode, we'll check in with some of Nomura's global research team. I'll be discussing the latest tariff twists and turns, fresh communication from Fed Chair Powell, and coming US data with Jeremy Schwartz from our New York-based research team. We'll take a look at that ECB policy decision and coming European data with George Buckley, our chief economist for Europe and the UK. And then across Asia, there's a couple of things to look out for, including Bank Indonesia's policy meeting, which I'll be discussing with Shannon Benut from our AEJ research team. Plenty there to keep us busy, I think, so let's dive in. All right, let's start with the US, and I'm joined here by Jeremy Schwartz again from our New York-based research team. Hi, Jeremy.
Hey, Andrew. Great to be back.
Great to have you here. Thank you again. Look, let's start with the Fed. We heard from Fed Governor Waller a little earlier in the week, and he was maybe sounding a little more dovish, I thought. And we've just heard from Fed Chair Powell today. So I wanted to ask, what did you make of this communication, and is it shifting your outlook at all?
Yeah, so we were a bit surprised by Waller's comments. He effectively said that tariff-driven inflation would likely be temporary. He even used the word transitory at one point, and suggested that the growth impact from tariffs ought to outweigh any inflationary impulse and actually get the Fed to ease more if tariffs do remain elevated. We think that Waller is a bit out on a limb here and doesn't really represent the core of the FOMC, or I think the message has been much more consistent. And I think that was really backed up by Powell in his comments to the Economic Club of Chicago in the middle of the week, where he really reiterated a lot of his points from several weeks ago, saying that the inflation mandate is going to be the priority for the time being, saying that the Fed was really focused on making sure that the tariff-driven inflation is just a one-off shock and that it doesn't leak into inflation expectations or any persistent price pressures. Powell even went a bit further to say that a stable inflation is a precondition for a healthy labor market, suggesting that they really would prioritize inflation even if growth starts to deteriorate a little bit. And interestingly, Powell also downplayed some of the recent stress in markets, saying that volatility was probably a reasonable response to the policy and macro uncertainty due to tariffs. I think there were some expectations that he might offer a little bit more of an olive branch, suggesting that the Fed might be there as a backstop in case market conditions became more disorderly. So overall, I think the message coming out of the core of the FOMC remains quite hawkish, remains focused on inflation. And I think it's very consistent with our outlook that the Fed is going to remain on hold for the time being, so long as growth can manage to muddle along. We continue to think that a rate cut is going to be delayed until later this year.
Got it. Okay. Now, you did mention tariffs there a couple of times. They continue to be the elephant in the room, of course. What do you make of the latest developments? And have you got any thoughts on the path ahead from here?
Yeah, so last week saw two notable reductions in tariff rates. First, the country-specific reciprocal tariff rates were postponed for 90 days for all trade partners except China. So that capped the country-specific rates at 10%. Second, which flew a bit more under the radar, but which was also quite important, the exemption for semiconductors was broadened to include computers, smartphones, and other electronics. So really a much more expansive set of exemptions. This is all contrasted with the further escalation against China, where the current top rate was raised to 125% for reciprocal tariffs, and that actually stacks on top of 2018-19 tariffs, as well as the 20% increase announced in February and March. The impact of the China escalation was blunted a little bit by the exemption of electronics, which is a large share of U.S. imports from China, around 22%. But all told, if you looked at our estimate for the average tariff rate just after the Liberation Day, April 2nd announcement, it was in the high 20s. After the actions last week, we think it's down more around 21%. So it's a notable step back from some of the extreme moves that we saw earlier in the month, and suggests that the administration is a bit more sensitive to market stress or some of the negative ramifications of tariffs on growth and inflation. You asked about the path forward from here. We think it's going to be a mix of escalation and de-escalation. I think following on from the reprieves of the last couple of weeks, the messaging out of the administration has been quite optimistic on potential bilateral deals with some trade partners to exempt them from reciprocal tariffs and potentially even get that across the board rate of 10% reduced in certain instances. We think we're likely to get more positive news on that front. But at the same time, some of the sector-specific tariffs are still ramping up in the background, and those are taking a little bit longer because they're going through a different process focusing on Section 232 investigations. So likely a mix of positive and negative developments from here for tariffs, but we think some positive headlines are probably the next step in the process in terms of how these negotiations unfold.
Okay, well, that would certainly be a relief, but I guess you're saying there's some steps forward, some steps back, so it's going to keep us on our toes, I guess. And Jeremy, look, just finally looking at the calendar, the week ahead, we do have some April releases starting to come through. I'm curious to see if any of those are going to show some weakness related to tariffs and market volatility. What are you going to be watching most closely there?
Yeah, so the hard data at this point is still lagged, still largely March data, but there are a few sentiment indicators on the calendar next week. The preliminary S&P PMIs, the final reading of UMISH, and probably most importantly, the Beige Book, which normally isn't so top of mind, but whenever you get a big shock like tariffs and the subsequent market stress, looking at anecdotes can give a kind of sneak peek of how the economic impact is likely to unfold. We expect the Beige Book to substantially downgrade its characterization of growth, saying there's little or no growth across most of the Fed districts. And we expect the comments to really highlight the supply pressures, the disruption, and really the headwind from uncertainty due to tariffs and some of the market stress around tariffs. So again, we don't necessarily think that you're going to get any feed through into the hard data so soon in terms of the tariff-related shock, but we're already starting to see some signs of pressure in sentiment, and the Beige Book will really, I think, help to clarify that next week.
Okay, got it. Jeremy, that's great. Thanks so much.
Yeah, thank you.
The outlook for growth has deteriorated owing to rising trade tensions. Increased uncertainty is likely to reduce confidence among households and firms, and the adverse and volatile market response to the trade tensions is likely to have a tightening impact on financing conditions.
Now, let's jump across to Europe. I have George Buckley from our London-based research team here with me. George, we've just had the ECB policy decision today, and President Lagarde's just wrapped up her press conference. I played a little snippet just then. What were the highlights for you?
Well, absolutely, Andrew, and it really is hot off the press, this. We've just finished listening to Madame Lagarde. It did all sound quite dovish. She was talking about the weakness in growth, downside risks. They've removed the paragraph talking about restrictiveness, but I think they could be. It's not our view, but they could be paving the way for more cuts. Certainly, another cut is likely in our view. We've got June, but there is a risk that they do more. And they highlighted that by talking about the significant downside risks from tariffs to economic growth. On inflation, very uncertain, but on growth, they were very clear about this, that this was going to reflect a meaningful downside risk to growth. And that obviously means that if they need to, they might have to do more. They're all about making decisions, meeting by meeting. They're not going to tell us where they're going until we get there. And of course, if things turn out weaker than they or we expect, then they could go further in terms of rate cuts.
Okay, got it. And George, turning to tariffs, I guess this is all a bit unpredictable, and it seems like we're entering negotiation mode from the US side. What's your sense of the outlook there for Europe? What's the end game on tariffs, do you think?
Yeah, well, the end game, as we've assumed at least, is that we've basically assumed the 2nd of April tariffs announced by Trump were the end game. That's what we've got in our forecast, at least at the moment. But of course, as you say, there is a possibility that we could see some positive renegotiation here. And Europe has offered 0 for 0 tariffs on industrial goods. I'm not sure that's gone down particularly well on the other side of the Atlantic. I think they still would like Europe to do more, but it's very tricky to know where we're going to end up. At the moment, it's 10% for everywhere, but for the UK, I think there's a much greater chance of a trade deal. That's certainly being openly discussed at the moment. We've seen that in a lot of press articles recently. For Europe, I think the US would like them to do more.
Yeah, thank you. It is pretty fluid. George, let's finish with an easier one. Standard question: calendar week ahead. What will you be watching out for?
Well, I mean, so far the data, a lot of the data, apart from maybe some of the surveys, has not really been focused on post-Trump tariff announcements. A lot of it has been for months like February and March, but we do get the April PMIs. Now, they are an indicator of actual activity. They ask the question, has activity changed between one month and the next? You wouldn't have thought the announcement of tariffs would have changed activity that much so far, but we have seen this number influenced by sentiment in the past. I would refer you back to the middle of 2016 with the Brexit vote, where in the UK the PMIs fell drastically and then rebounded drastically the month afterwards. So I think there's a possibility those PMIs could be weaker. We get some other surveys, including the IFO survey in Germany. Same goes for that. The Industrial Trends survey in the UK from the CBI. That one actually contains a key quarterly balance on uncertainty, and I wouldn't be surprised, or optimism, and I wouldn't be surprised if that really does take a hit from what we've heard from tariffs. We also get retail sales in the UK and consumer confidence in Europe as well. So lots of important data coming out in Europe next week.
Okay, a fair bit there. George, excellent. As always, thanks so much.
Thanks, Andrew.
So let's bring the focus to Asia, and I'm joined here by Shannon Benut from our AEJ research team in Singapore. Shannon, great to have you on the podcast.
Yeah, thanks, Andrew, for having me. It's my pleasure.
Excellent, thanks. Now, look, I thought we'd start with Bank Indonesia. They are meeting next week. What are we looking for there?
Well, we expect BI to keep the policy rate unchanged after staying on hold in February and March. Our view is in line with the consensus forecast, mainly because of the continued underperformance in the IDR, which has been one of the worst performing currency in Asia so far this year. I would say that the BI will focus on its FX stability mandates, and because of the increasing BOP pressures coming from the global trade war, will be something that the BI will need to be mindful of. And when we are in the second quarter of this year, it's not particularly strong in terms of the seasonal period for the current account. So we think that the window for the BI rate cut should be very limited for this quarter.
Okay, got it. That is interesting. I know that a number of central banks have the flexibility to look past currency issues when they consider their policy decisions, but it's a big deal for Bank Indo, of course. Now, just looking towards the calendar for Asia next week, is there anything you'd like to highlight?
I would say that the 20 days export for April for South Korea will be especially important to watch. It will give investors an edge to kind of assess the early impact of the global trade uncertainty following the Liberation Day. But given that the tariff was paused over the next 3 months, and the fact that the sectoral tariff, especially on the electronics sector, is not yet announced. So we expect some sort of front-loaded demand, which would kind of boost export of Korea in the near term. So we expect the first 20 days exports of Korea to see some improvement in terms of growth.
Okay, that's really interesting. I think we're all looking for hard data for April to start to come through to see impacts of tariffs, and looks like Korea is going to give us an early read there. That will be interesting. Hey, Shannon, that's great. Thanks so much.
Thank you, Andrew.
Now, one other quick highlight for Asia. In Japan, April Tokyo inflation data will be released late next week. All measures should jump quite sharply, but don't be fooled. That would largely be driven by base effects, with the impact from the introduction of free high school education and free school meals a year ago dropping out of the annual calculations. This week, our Japan research team took 25 basis points out of their BOJ rate hike profile, removing their call for a hike in July this year, with the central scenario now being for only one more BOJ rate hike in January next year. That decision reflected a combination of expected downward pressure on the economy due to US tariffs, a likely change in the overall policy mix, with the government expected to introduce an economic package in a few months or so, and the risk of lower wage increases next year. And finally, for Japan, we will be on the lookout for any further headlines regarding US-Japan tariff negotiations, noting that Prime Minister Ishiba was reported today as saying that frank, constructive discussions were conducted this week and that the government will continue to consider trade negotiations a top priority. So there you have it, short and sweet, our views on major market themes and what to look out for next week. Written by Andrew Ticehurst and the Global Markets Research Team, expertly edited and produced by John Dalton. Thank you for listening to our podcast. If you did enjoy listening to the show or want to hear more from Nomura's economists, researchers or investors, please like and subscribe to Nomura's podcast on Apple, Spotify and SoundCloud or wherever you get your fill of podcasts. If you have a moment, please leave us a review. And as we always say, it would make our day if you could press a few buttons and share this podcast with a colleague or a friend. For more, log on to nomurakonnects.com to keep up to date and to keep on listening. Thanks, goodbye for now, and see you next week.
In a complex and unpredictable world, where a sunset in one market means a sunrise in another, one investment bank always looks beyond the horizon to help our clients release the potential of tomorrow, today. Nomura, connecting markets, east and west.
Disclaimer. This content has been prepared by Nomura solely for information purposes. It is not intended to form the basis of any investment decision and is not an offer or solicitation of an offer to buy or sell or enter into any agreement with respect to any security, product, service, including but not limited to investment advisory services or investments. The opinions expressed in the content do not constitute investment advice nor is legal, regulatory, accounting or tax advice and may change at any time without notice. You should seek independent advice as appropriate for individual circumstances. For further information, disclaimers and disclosures, please visit Nomura Connects at www.nomurakonnects.com.